So, this is a graphical representation on this slide of what's called Modigliani-Miller, which is going to be important for a lot of the work that we do this semester. So the idea is a company's worth the sum of its future cash flows, present value today, that's going to be the overall value of a company. That's the expectation cornerstone. So what we're going to do, though, is we're going to follow the process of Modigliani-Miller, and we're going to take the step to take the cash flows and to put them into two categories, or two buckets. The first is called the operating cash flow bucket, and the other is called the non-operating cash flow bucket. Okay? So operating cash flows are the recurring cash flows that are a result of selling products and services to a customer. It's why you're in business, right? But businesses also can generate cash flow from other things that have nothing to do with selling products and services from a customer. We will define those as non-operating cash flows. And then what we're going to do, since they're present valued, is we will add them together to get something called enterprise value, or EV for short. Right? We'll then take the enterprise value, and that is the cash available to pay to the stakeholders. The debt holders get paid first, so we'll then pay off all of the debt, and we will define debt in this class as anything with an interest rate attached to it. So if the amount paid later is different than the amount paid today, it's debt. If the amount paid later is the same as was paid today, it's just a liability. That's how we're going to separate out the two. Okay? So once the debt is paid off, shareholders get whatever's left. The residual is called the equity value. Matter of fact, divided by share, that's share price. That's enterprise DCF. It's actually a very straightforward process, right? So here's the deal. The process is not the problem. It's putting the cash flows into this format that becomes the challenge. And that's what we're going to spend a lot of time on today and the rest of the semester. And that's what's actually unique to this class, because other people don't do what we're about to do. Okay? This is a McKinsey-driven format. And by the way, I learned about it teaching at McKinsey. It used to be part of their analyst training program. And they talk about it in the book. That's our textbook. But it's really not taught hardly any other place in the world. It's here, Wharton, and I don't really know any other academic institutions that actually do this. So you're learning McKinsey format statements. But what you're going to find is this process, once you do it, is very helpful and gives you a much cleaner view of what's going on. Right? But nonetheless, it's going to be foreign to you, and we have to learn it, and we're going to start here today. So what does that mean? Well, what I'm going to do is I'm going to give you a mnemonic that will help you learn this stuff. Because when I was at the ATP, McKinsey would hire like poetry majors and history majors along with physicists, and they'd send them to this month-long boot camp to teach them business in a box. And I'd have a day and a half with them to teach them everything they needed to know about corporate finance, including this. And so if I can teach them, I know you guys can pick this stuff up. Right? But what I found is the mnemonic, particularly people that are not used to seeing these statements, was very helpful. So here's the mnemonic. We're going to call operating cash flows in this class ones. Non-operating cash flows, twos. Debt cash flows, threes. And equity cash flows, fours. And if you talk to anybody else outside this class, they're going to think you're nuts. They're like, what the hell are you talking about? Because this is Joe's methodology, Professor Perfetti's methodology. But I'm going to show it to you because I think it'll help you. If you don't want to use it, fine. You don't have to, okay? But you're still going to be graded on getting a right answer, and I think this will help you. So 1, 2, 3, 4. Those are the 4 boxes. Is that your question?
Yeah, I just can't see.
Okay, yeah, it's hard to see on the screen, I know. So 1, operating, 2, non-operating, 3, debt, 4, equity. Enterprise value doesn't get its own box. So the next slide is the roadmap for what we're going to do. It's a 3-step process. We're at step 1. Step 1 is we start with GAAP financial statements, the income statement and the balance sheet. Step 1 is label them. We label everything on the income statement and the balance sheet, 1, 2, 3, or 4. Right? And just like in the Lego movie, when we rearrange these statements, what we're going to do is we're going to be like a kid with a Lego toy that rips it apart, and puts it together as something else. And when we put it together as something else, no Legos can be on the floor. Every brick has to be accounted for. So the rearranged statements will still balance. It still includes all the items on the income statement and the balance sheet. And that's actually going to be one of the challenges, because if you forget to do something, then your statements won't balance and you won't get credit. Right? And that's actually something unique here that people don't do in the real world. Because in the real world, they'll calculate cash flow, but they'll stop at cash flow and they won't foot the statement to see where the cash flow was spent. In this class, we're going to foot it, because by footing it, it minimizes mistakes. Okay? So let's go on. So when we do the first two statements, we're going to take the 1, 2, 3, 4s, and then we map them to Modigliani-Miller, and then we're going to put them into the Modigliani-Miller framework. The income statement rearranged is going to be called TII, total income available to investors. The operating items, all the ones, will give us our no plat. The non-operating items will give us our non-operating income, the 2s. You add those together, that gets you total income available to investors, TII. From a footing perspective, that income is distributed to the debt and the equity holders. The debt distribution is your interest expense. The equity is the net income. 1 plus 2 equals 3 plus 4. Same thing with the balance sheet. We're going to net all of our operating assets and liabilities together. It's going to be called invested capital. We're going to net all of our non-operating income and non-operating assets and liabilities together. Non-operating assets and liabilities together. We are non-operating capital. Add it together. It's called TFI, total funds available to investors, total funds invested. We're then going to finance this with interest-bearing debt plus equity. So 1 plus 2 equals 3 plus 4. Once we've reorganized those two statements, we'll create statement number 3, which is called the cash flow statement, CFI, cash flow available to investors. No plat minus change in invested capital is free cash flow. Non-operating income minus change in non-operating investments is non-operating cash flow. Add them two together, CFI, cash flow available to investors. By the way, forecast your free cash flow, get operating value. Forecast your non-operating cash flows, non-operating value. Add them together, get enterprise value. Or take your CFI, which is the free cash flow and the non-operating cash flow, forecast it, you get enterprise value. So by putting in these statements, it actually gives us great flexibility to work vertically or horizontally, and it also helps with analytics. What's ROIC? No plat divided by invested capital. We got a clean no plat, we got a clean invested capital. So the benefit will occur after we put them in the format. Unfortunately, accountants do us no favors. So we have to take the accounting statements, and then we're going to do a lot of work to put them into this framework. Right? So that's what we're going to do today. So the first statement we're going to start with, just arbitrarily, it's going to be the balance sheet. But before we do, I want to give you a hint of a why. And if you look on the left, you have what I call traditional ROIC. This is the ROIC that you see in Bloomberg. Every assignment you've done to this point in the semester, when you did ROIC and you did your analysis, was what I would call traditional ROIC. It's what's used in the real world. It's default in Bloomberg. It's taught at every business school. It's taught in every business school textbook. It's what you learned at every one of your classes prior to coming into here. And I'm not saying there's anything wrong with it, but we're going to improve on it because, unfortunately, it has a little bit of a challenge, which I'm going to show you. The ROIC, when we rearrange it, which we haven't done yet, is to be called the operating ROIC. The primary difference is the traditional ROIC has the operating and non-operating cash flows intermixed. When we strip out the non-operating items, we're going to get a clean operating ROIC. And you might say, why does that matter? Let me show you. So a few years ago, I was working with a beer company called Molson Coors. All right. Ticker symbol, you can look it up now in Bloomberg, TAP, T-A-P. RV. Go to our spread template. Okay, let's say that Molson Coors in the beer industry with this data was your assignment. Public data. What would you say? Is this an attractive industry? Mm-hmm. Yes or no? Okay, because it has a positive spread, 16.68 minus the 6.89, attractive industry. How is Molson Coors doing? Pretty poorly, because they're borrowing at 7.22 and they're making 4.98. So they have a negative spread in a very positive spread industry. All right? Now, you just did a key value drivers assignment. What happens when Molson Coors adds a lot of G? They add a lot of growth. It's actually going to get worse for them, right? We all now know that, given key value drivers. So the answer should be that they should actually slow the growth, right? All right, so I'm going to shortcut this. So about 6 or 7 years ago, 5, 6 years ago, a while back, I was actually brought into Molson Coors because they were in this situation. And they brought me in to basically explain. They had a big leadership conference at the Westin in Fort Lauderdale, Florida, to basically explain this data to their employees so that the senior management could understand why the pending job cuts and reorganization that was about to happen was going to actually happen. And they could actually see that they were performing much worse from the market's perspective than they probably really understood. So I was the precursor, or like I would call myself, the angel of death, to their otherwise happy party that they were having at their annual kind of leadership meeting. Again, it was spring break at the Westin on the beach with free-flowing alcohol and live music. Like, it was a party, right? And I had 20 minutes to basically say, you're one of the worst performing beer companies in the world in an attractive industry. You guys suck, right? That was my message. So in case you wonder, like when I'm doing things in the real world, this is what I get hired to do. So, but here's the real world story. So this is the data, and it hasn't changed. This is the data. This is real data today, okay? So here's what I would say. I'll give the same message today that I gave them, and nothing's proprietary because I'm looking at the same data you are. And here's the data. You guys are actually doing pretty well. You need to accelerate your growth, not slow down the growth, and sell more beer. Does that make sense given the data you see on that screen? Again, you could have heard a pin drop in that ballroom. I got the board, I got the CEO and his management team. They think I'm going to basically come in and say that they suck and they should be slashing their business. And I'm like, you guys are actually doing pretty good. Huh? Well, here's the problem. What is that ROIC? Is it the one on the left or is it the one on the right? It's the one on the left. So what does that include that the one on the right does not? Non-operating. I'm sitting in a ballroom with a leadership team that makes beer worldwide. Are they controlling the non-operating assets or are they controlling the operating assets? And the layoffs are going to occur to the people that are controlling the operating assets. So what I did is I separated out the operating assets and the non-operating assets because I'm talking to the people that actually make beer. They're in the operating business. So there is a custom field that does not exist in Bloomberg that you will be putting into Bloomberg, but you got to learn how to do it first. And it's called operating ROIC. Doesn't exist for you yet, but it will soon. Operating ROIC. It literally is that. It just takes the operating profits and the operating investments, similar process that we're going to do, and it's going to calculate them. You won't be able to do what I'm about to do. It does not exist today in your account. That is the operating ROIC in 2018 for Molson Coors. So here's my question. Is that a positive spread? Yeah. What happens when you slow the growth?
You're slowing the positive spread between operating and
so what happens to your value? You guys just did a key value drivers assignment. What's going to happen to the value? So there's the point. I gave them the opposite message that they expected. I gave them the opposite message that Wall Street was pushing them on. Because the analyst looking at Bloomberg was like, you guys suck too. You should be just getting out the axe and start hacking away at your business. All right? I'm not saying that Molson Coors is doing well. They're earning 5%. They need to improve that performance. What's the real problem here, though? That ROIC, the ROIC LF column, is an average of operating and non-operating combined. What's the operating? What's the operating ROIC? 11.27. So by definition, what's the non-operating ROIC? Below 5. It's an average of the two. So what do they really need to focus on? Fix the non-operating stuff. That was my message. Oh, by the way, 11's lower than 27. Could you do better? Sure. But should you gut your growth because your ROIC for your enterprise doesn't look good? That's naive. And by the way, this is what separates McKinsey from Goldman Sachs, JP Morgan, Deutsche Bank, UBS, and the other bankers. This is why they're good, right? Because they go in there with this approach, and the bankers don't. The bankers use the approach that's on your screen. Okay, they don't bother to separate the stuff out because nobody taught them to do that in business school. I'm not saying that a few of them don't, but you're not taught to do it this way. And I'm teaching you early on to do it this way. Now, I also want to be really clear that senior leaders at these companies, as well as professors in your other classes, have fragile egos. And if you as a student walk in there and tell them that they are doing it wrong, they will fail you, right? Because their ego cannot handle being told by a 20-year-old stupid student that their PhD-driven background is incorrect. So be very careful with the information I'm giving you in this class, because I'll also tell you I will never work at Molson Coors again. Because who brought me into Molson Coors? CEO. And what did I really highlight? Who do you think made all those non-operating investments? CEO. So I'm basically explaining to them that the real problem is not them, it's the CEO, when the CEO wanted to blame them. Okay, so again, I don't care. I got a university job. I can go back to this, right? But you don't. So I just need to be very careful with the information. So I'm saying sometimes people take shortcuts. Sometimes people do alternatives. I'm not saying there's anything wrong with that. But one of the things you're going to learn this semester is when people take a shortcut, that they took a shortcut. And they took a shortcut on Bloomberg. And it's universal. And what they did is they didn't bother to separate out operating and non-operating items. That's what's in the ROIC. That's standard in every terminal, everywhere in the world today. The 300,000 finance professionals use that comes out of textbook like Brealey and Myers that you were taught to do. So, little nuance. So, here's the deal. Let's go back to our assignment. We're going to start out with a simple income statement and balance sheet that was in the textbook. Just keep it simple. I put this into this spreadsheet. So, step one is labeling. So we're going to take this very simplistic income statement balance sheet and we're going to label it 1, 2, 3, and 4. Is it operating? We're going to call it a 1. Is it non-operating? We're going to call it a 2. Is it an interest-bearing debt? We're going to call it a 3. Is it equity cash flow? We're going to call it a 4. So let's start out with cash. 1, 2, 3, or 4. What is it? 1, 2, 3, or 4?
No, that's it.
Okay. It's actually a 1 or a 2, but for this example, McKinsey calls it a 1. All right? So, nuance. I'm 18 years old. I'm a senior in high school. My job was basically to work at the Burger King drive-thru, minimum wage. Okay? It wasn't a fun job, but I did it, and it makes some money. So long story short, I'd walk into my shift. I'd go back to the manager's office, and we'd literally start my shift as soon as I clocked in with a till that goes in the cash register, and we'd count the cash in the till. It was always the same amount. And then I would literally pick it up. I'd walk to the register with him. He would take the till out of the register, replace it with mine. He'd turn a key. He'd print out a label so he could manually see how much was actually sold during that shift and start the clock on my shift. At the end of my shift, the same process would be repeated. Somebody else with a till would replace my till. I'd walk back to the manager's office. We'd count the money. We'd leave the starting amount in, and any amount above the starting amount would be taken out. Okay? Now that for me was actually kind of insightful in later life, because what I realized is what was the money in the till really called? Operating cash. And why did Burger King leave the same amount at every franchise in the till for every shift? Why couldn't they take it out? Yeah.
Can't start the day with zero cash.
Exactly. How do you make change? I mean, particularly then, there was a credit card-driven world. Even today, you can't go to McDonald's and just have 100% credit cards. So that's the point. Like, people couldn't actually buy things if they didn't have the ability to make change. So that's the point. There's an amount of cash that every business has that can never be paid out. And that's called operating cash. And it's no different than inventory. And that's a nuance that we're going to put forward in this class that other people will look over. Is that you really can't go to zero cash. You just can't. You won't function. So even when we do net debt, what's defined as net debt in other classes will be defined differently as net debt in our classes because it's debt minus excess cash, not debt minus all cash, because all cash is naive. I'm not saying it's not a shortcut people do, but what I'm saying is just like Burger King can't make change, they can't function, they can't pay that cash out. The cash they can pull out, the excess cash, is the cash that can be distributed. That's a 2. The operating cash is a 1. The excess cash is a 2. You're going to do that on your next assignment, your homework. But for purposes of this example, McKinsey started simple. We're just going to call it a 1 for this simple example. Okay? Now, for your homework and your midterm, I am not going to make you choose what's operating in excess. You're going to get 2 buckets. One's going to be called operating cash. One's going to be called excess cash. I'm going to make it really easy on you. Where it gets tricky is when you get to the real world, right? Because companies like Ford don't say, here's our operating cash and here's our excess cash. They just have cash on a balance sheet, right? And we're going to have to figure that one out ourselves. But that's post-midterm, okay? But that's coming. Right now, we'll keep it simple. All right, so 1, 2, 3, or 4, that's a 1. Inventory, 1, 2, 3, or 4. Operating 1, non-operating 2. What's inventory? It's operating. You don't have inventory, you can't sell to the customers. That's operating by definition. The building, plant, and equipment, the property, plant, and equipment that you make the product in. Operating or non-operating? Operating. Therefore, PP&E is generally considered operating. Equity investments. I buy a stake in another company, and I don't control it. 2. It has value, but I don't run the company, so that's a 2. Total assets is a total. Totals don't count. Accounts payable. 1, 2, or 3. Is accounts payable debt? No, because it doesn't have an interest rate attached. If I pay you in 60 days or 90 days, the amount doesn't change. You might get pissed off, but the amount doesn't change. So therefore, it's not a 3. So is it a 1 or a 2? Is it operating or non-operating? Typically, it's a 1, because the vendors that I'm waiting to pay are typically the vendors to build that inventory and to run my business day to day. So it's typically considered operating. All right, debt. I have interest-bearing debt. 1, 2, 3, or 4. That's a 3. Retained earnings. That's a 4. That's equity. By the way, this is another example of where things get complicated and why you can't use Investopedia in this class. What's the definition of working capital in accounting? Isn't it current assets minus current liabilities? Okay. In this class, it's operating working capital. So guess what's not part of current assets? Excess cash. Guess what's not part of current liabilities? Short-term debt. Because what's short-term debt? It's a 3. It's not a 1. It's not a 2. So this is what I mean by, it's straightforward, the principles, but we start applying them to what you learn in accounting, it gets confusing really fast. Because what the accountants call working capital and what we're going to start calling operating working capital is not the same thing. I don't care if short-term debt's short-term or long-term, it's debt. It doesn't belong in working capital because it's a financing part of the business. And so we're going to be much cleaner about the cash flows and the investments on the statements that were provided than what the accountants were, because we're trying to do it based on value, which is different than what the accountants set those statements up to do. So, long story short, I then create a new tab. In this class, every statement gets its own tab. That's why you're going to learn Excel. So the first thing you'll probably want to do is copy and paste. So data, take my years, copy them, paste them, and then I start assembling. I want all my ones to be together. All my operating assets, net of my operating liabilities, that's invested capital. That's operating invested capital. So anything labeled a 1, this is where labeling helps me. It's my cash, my inventory, and my property, plant, and equipment. Those are my three asset ones. And then I say, do I have any liability ones? Yes, I have something called accounts payable. So since that's my only ones, the four of those, I have something called operating invested capital equals that plus that plus that minus that. That's the 380 and the 440, what I have tied up in operations to build my products and services. Right? Then we do the same thing with my twos. Do I have any assets that are twos? Yes, I have one called equity investments. Do I have any liabilities that are twos? No, but if I did, I would put them on there just like I put on accounts payable. Hint, you will have that in a future assignment. That gets me my non-operating capital, which is just the 15 and the 25. So that my TFI, total funds invested, equals the operating invested capital plus the non-operating capital, 395, 465. So I'll just shrink this for a second so you can see what we just did. But basically we said, here's the operating investment, here's the non-operating investment, add the two together, TFI. Then anything that's a 3, any interest-bearing debt. Well, I only have one. Doesn't matter if it's short or long term. Copy that. Anything that's equity. Add my 3s and 4s together. Notice the 395 and the 395 balance, the 465 and the 465 balance. And that's what becomes very important about footing these statements, right? Every statement must have two sides that you do this semester. Every statement must balance. And here's why labeling helps you. What if, for some reason, I forgot to put in accounts payable? Does my TFI balance? So what if I put in 395 as an answer to one of my assignments, but I have an unbalanced statement? In this class, you get a 0. So just like in this class, I don't care how many words you write. If you don't refer to numbers, you get a 0. In this class, I don't care if you have a right answer. If you can't show me that it had to be a right answer by giving me a balanced statement, you don't get credit. Because if you chose 395 and your two options were 395 or 520, then you were just a lucky guesser. You had a 50% probability of guessing, and I can't say that you couldn't have easily chosen the other answer and had it wrong. So you just got lucky. The only way that I know that you know it's the right answer is if 395 matches 395. So in this class, not only must you have the right answer, but you also must have your balancing statements. So I'm just getting it out of the way now. On the next assignment, when the TAs give you 0s, they're going to give you 0s for unbalanced statements, regardless of what you type in. And there is no partial credit for guessing the right answer with an unbalanced statement, right? Because listen to the statement that I just said. Guessing the right answer doesn't get credit in this class. The way you get credit in this class is if you know it. And the only way you know it if the statements balance. That's actually why labeling will help you. Because if you did the labeling process, there's 4 ones. But on my statement, I only have 3 ones. Oh, I must be missing a 1. That's why I'm teaching you labeling. So the real benefit of this labeling process is there's 2 likely errors that will happen. The more common one is there's a Lego brick on the floor. And if you can't figure out how to get that Lego brick into the new statement, you'll never get it to balance. So by having the 1s, and you can literally count them, the 2s, 3s, and 4s, you can generally make sure that you've accounted for everything. The second answer is harder, which is a common problem, which is you mix the 1s, 2s, and 3s, and you put a 3 in with the 1s. So for example, let's say short-term debt was on here, and you mistakenly called short-term debt a current liability. That one I can't help you. Because if you put a debt cash flow into an operating cash flow, then you will get the wrong operating invested capital. And you will then get a wrong answer. So there's 2 errors. The first error is basically you don't have all the items. And the second error is you miscategorize something. But again, labeling will help you. And prior to the midterm, I'm going to give you the labels. So you don't have to figure out what the 1, 2, 3s, and 4s are. I'm kind of putting you on training wheels, and I will help you, even though we just did this exercise, understand the 1, 2, 3s, and 4s. Now here's the deal. When we get to the valuation part of this course and we get to real world financial statements and you're doing Delta Airlines financial statements, Delta Airlines doesn't go out of the way and say, oh, here's our 1, 2, 3s, and 4s. And you have to actually balance those statements when you convert them to value Delta Airlines as part of your group project. And so that is what you will then be responsible to do later in the semester. But at least for these assignments, I'll tell you what the 1, 2, 3s, and 4s are, right? But let's continue on in the interest of time. So let's get this one back right. Put my 1s back. Balancing statement. Statement number 2, TII. This is the rearranged income statement. So again, if I go back to our process, we're converting these 2 statements. We're now going to the TII. This is the income statement next. So same process. Take the years, and then I need to start moving over the 1, 2, 3s, and 4s. So for my income statement, revenue, 1, 2, 3, or 4. What's revenue? Operating or non-operating? Yeah. Generally 1. It's operating. That's the whole point of revenue. I'm getting revenue from my customers. I've sold them products. That's why I exist. It's operating. Every now and then you can get a non-operating revenue. It's very rare, but nonetheless operating. Operating costs. Misspelled that. Operating costs. I'll give you a hint. The word operating's in it. Depreciation. Operating. I'll give you another hint. Where did depreciation come from on the balance sheet? PP&E, right? We call PP&E operating the balance sheet. Therefore, what flows through to the income statement must also be operating. It's 1. Back here. Operating profit, sum of all those. Interest expense. One, 2, 3, or 4.
Wait, what operating cost?
Well, it's associated. Where to come from on the balance sheet? Interest-bearing debt. Debt was a 3. Interest expense is a 3. Cash flow to debt holders. Equity income. Where did it come from on the balance sheet? Where did the equity income come from? Equity investments. It's a non-operating cash flow. 2. Taxes. I'll give you a hint. It's a trick. 1, 2, 3. We are going to spread out the impacts of taxes into each of the areas. Net income. Who's that belong to? Who gets the net income? That's shareholders. That's a 4. Not on the income statement, but dividends. Who do the common dividends go to? 4. That's an equity cash flow. And to get our tax rate, we take our profit before tax divided by our pre-tax income. Okay? Or sorry, taxes, divided by profit before tax. So, TII. Now, I am going to be lazy, and I'll let you be lazy as long as you accept that if you're lazy and you make a mistake, you'll get no credit. But one of the ways I'm going to be lazy is operating profit. Usually operating profit is the net of everything above. So rather than putting in 3 line items, I'm just going to call this a 1 and start with operating profit. Okay. Now, I'll let you know, for purposes of your homework and for purposes of the midterm, I'm not going to throw a curveball at you. And operating profit, you could start there. However, in the real world, that may not be the case because accountants are sneaky in the real world. And they can put items above EBIT that are non-operating. And we have to be careful when they do that, right? So I'm not going to try and trick you here in an academic assignment, but when we get to the real world post-midterm, we're going to have to watch out to see if they've buried a non-operating item above the operating profit line, okay? Because that happens. So I'll start out with operating profit. Copy this. All right, if I made $280 million of operating profit at a 25% tax rate, my tax on my operating profit equals that times 0.25 would be 70 million. That's my operating tax on my operating profit. Subtract it, and then I get my no-plat, which is the 280 minus the 70 I would pay in taxes. 210 of no-plat. By the way, that's the difference between no-pat and no-plat. No-pat in Bloomberg is not this. Somebody asked me on the key value driver assignment. They said, the email basically said, can I use no-pad in Bloomberg to help me do key value drivers? And I was like, well, yeah, you can, but long-term you probably shouldn't. And here's why. Because no-pad in Bloomberg is operating and non-operating mixed. No-plat is clean operating. That's the real difference between the two. Now, if you don't have non-operating items, they'll be the same, but that's the primary difference between no-pad and no-plat. Okay? So, no-plat 210. All right, let's continue on. Then we take our non-operating profits. Twos. The only 2 I have is equity income. I made $4 million of equity income. Well, if I make $4 million of equity income, my tax on equity income, I'd have to pay 25% of that. What the hell? Mouse is having all sorts of trouble. C6 times, there we go. Where's an I coming in there? Would be $1 million, which means my after-tax equity income would be $3 million. So again, gotta be careful. Now, they take shortcuts in the book. Again, Dave Wessels, I've known him for years. He's worked so long. When he did the table in the book, it was just so intuitive for him. He didn't have to write out the tax on items. He'll just put the after-tax item. And if you're smart enough that you know how to do that, that's fine. You don't have to write this out. But I even find it's helpful for me to write this stuff out because I know what's going on. So I could have just gone to 3 of after-tax equity income and just put in 4 times 1 minus the tax rate. But it's easy to see, okay, I had $4 million pre-tax, I pay a quarter of it in taxes. I'm left with 3 after tax. That's how I got to the 3. Okay. When I add the two together, I get my TII, which is 210 million from the operating part, 3 million from the non-operating part. I generated 213 million of cash that I can then distribute to my stakeholders, the debt and equity stakeholders. The investors get the 213. Now, the next part is going to confuse you. So let's be really clear. This is not GAAP. This is McKinsey's version of Modigliani-Miller. Okay, so they have a different set of rules for their statements. The way they've set up the statement to match the M&M model is that I have 213 million of cash to pay out. I then distribute 213 million to my investors. So the other side of the statement has to equal 213. The other side of the statement won't be negative 213, it'll be positive 213. Therefore, on what's called the financing or fund flows side of the statement, payouts, distributions are positive numbers. That's the setup of the statement. Inflows are negative numbers. Here's the general rationale. If I have cash to pay out, then the payouts are positive. If I lose money, then I need to borrow money, which means my financing inflows will be negative to the firm to finance the negative losses. Okay? That's just something you're going to have to get used to with these statements. Reason why. My next is to look at my 3s, my debt. On the income statement, my debt cash flow was the interest expense of 20 million. Now, the format that the accountant gave me was negative 20. But under the rule that I just gave you, is that a distribution to the debt holders, or is that new borrowed money coming into the company? Or said another way, is that a positive 20 or a negative 20? Because if it's a distribution to the debt holders, it's a positive 20. So therefore, we need to flip the sign. There is no hard and fast rule for whether you need to flip signs, because I can't tell you the format of which the data is always going to be provided to you. This is where you're just going to look at the data and you have to think about it. That's the only answer I can give you. But here's the thing. Assuming we reported to the government 20 million of interest expense, the tax shield of deducting this is we take 20 million times 25%, and we would essentially save 5 million in taxes by deducting this. That's our 3, so that our after-tax interest expense is 15. Our final income statement cash flow is net income. That's the equity. And our net income is 198. So by the way, TII, if I take my 15 that I'm giving to my debt holders after tax, and I add the 198 that I'm giving to the shareholders for my profit, 213 equals 213. I made 213, I distributed 213. 198 to shareholders, 15 to debt holders with the government subsidy. By the way, a more clean view of this, I generated 210 million from operating activities, 3 million from non-operating activities to get to the 213. I then gave 15 to the debt holders and 198 to the shareholders. That's the Modigliani-Miller view of what we just did. Make sense? Questions? All right, I told you that the tax was going to be split, but we still, I told you, can't have any Legos on the floor, which means we still have to pay 66 million in taxes when all is said and done. So when we reorganize the tax, did we pay 66 million in taxes? Well, what is 70 plus 1? Thank you. And how much did we save on the tax shield? What's 71 minus 5? So we're still paying the same amount of tax, But by moving the tax into each of the areas, it's clean. So I know how much tax I'm paying on operating activities, how much tax I'm paying on non-operating activities, how much tax I'm saving by having debt in my capital structure. By the way, if I work for a private equity firm and I'm levering up a firm, this clean view of the debt and the tax shields helps me understand the spreadsheet scenarios I do when I think about debt trade-offs for the firm. I actually have a clean view of doing this with my cash flows. Yes? Because on the income statement ends with net income. Dividends is not on the income statement. But that's an excellent question that she just asked, because if you tried to throw the dividends on this statement, it would never balance. Okay? So the short answer is because the income statement ends with net income, and dividends is not technically part of the income statement. However, that's a good lead-in to statement number 3, which is cash flow. Because on the cash flow statement, the CFI, net income is not a cash flow. The actual cash distribution to the shareholder is the dividend. So when we get to the CFI, one of the tricks is instead of using net income, we'll use dividends. But on the TII, we use net income because we're rearranging and have to foot that accounting statement. All right, any questions before we go on? All right, I want to close one loop before we do CFI, but here's the deal. By doing this, we now have a clean ROIC. Operating ROIC, no plat divided by operating invested capital is operating ROIC. It's now clean. We also have a non-operating ROIC. After-tax equity income divided by non-operating capital is non-operating ROIC. The average is TII. TII, total income available to investors, these two together, divided by these two together, non-operating and operating capital, is TFI. TII divided by TFI is what Bloomberg calls ROIC. That's the Bloomberg definition. This is the Bloomberg no plat. That's no patent Bloomberg. It would be 213. This is the nuance. Our version of no plat in this course is going to say it should be 210 because Bloomberg is putting $3 million of non-operating expense in their calculation of no plat. The ROIC that Bloomberg gives us is going to be different because they're not separating out these $25 million of equity investments when they calculate invested capital. We will. So really what you've learned as ROIC in other classes and what the real world uses is a return on TFI. Okay, just terms. So again, I'm not saying it's wrong. It's academically correct. The difference is they're not separating out operating and non-operating. They're leaving them together when they forecast. And what I like to say is when I went to business school in the 80s at Wharton, when these textbooks were first created, I joke, but it really was a simpler time. Like we didn't have a lot of non-operating assets at most companies. So when the academics first set up the formulas, they didn't worry about the distinction because for the average firm, it didn't matter. You didn't have Apple with $200 billion of cash sitting in Ireland because they're trying to avoid U.S. taxes. You just didn't have that, right? Now you do. And that cash is so substantial outside the U.S. that it's distorting the ROICs and the definitions that were built back in the 70s and the 80s. And so if you wonder, it's not like they're not smart, like they were smart. It's just they didn't have to worry about it 30 years ago. Now they do, right? And that's why we're actually taking the time to do this. Because when you see a real world example like the beer industry and Molson Coors, you start to understand that this could actually lead to you mispricing an investment, right? Because basically, I'm thinking that when they sell beer, they're making 5%, but no. When they sell beer, they make 13%. And if they keep selling beer and they fix the non-operating profits, the ROIC is going to trend up over time. It's not going to trend down. And that's what I'm saying. Those are the nuances that we're going to get better at doing over time. And that actually will get closer to the real values of the firm when we do our valuations. Anyways, back to our statement number 3, CFI. I'm not going to lie to you. This is where you're going to spend time. In the past, when I've run this assignment, people will say, I can get the first two statements for our homework done in an hour, but I spent 3 or 4 more hours in the next statement before I gave up. Okay, so I'm hoping that this won't be you, but nonetheless it could. So let's talk about the third statement, and let's try and make sure that you don't give up. So what is the format for the CFI? First, in order to do CFI, you have to do the first two statements first. You can't do CFI until you've completed the first two. I'm going to go back to the PowerPoint to help you understand the third statement. This is CFI, cash flow available to investors. What you do is cash flow is income statement minus change in the balance sheet is cash flow. Income statement minus change in the balance sheet is cash flow. You are going to repeat that process 4 times. You're going to do it for operating. Income statement, operating, no plat, minus change in invested capital, free cash flow. Non-operating income, minus non-operating capital changes, non-operating cash flow. Add them together, CFI. Interest payments to debt, minus change in debt, debt cash flow. Nuance, dividends, not net income, minus change in equity, equity cash flow. So, and these two will add up. So that's the process that we're going to do. Very straightforward, but the devil is in the details. So now let's get into the details. So to get free cash flow, the specific definition is, and again, I'll copy over the years. Just make it easy to copy and paste. All right, make it a little bit bigger again, easier to see. So here's what I'm going to start with. Start with my no plat off the TII. And my no plat, which is my 210. And then what I'm going to do is I'm going to add back depreciation. And my depreciation was 20. To get something called gross cash flow. This is the cash flow coming from the income statement. 210 plus 20. So I generated $230 million of after-tax cash profit from the income statement. Okay, because the 20 was non-cash. And again, this is where I had to forget about the signs. I need to add back depreciation. So just figure out a way to add it back. I don't care what the sign is. Okay, so that's the point. I got 20. So you want to do double negatives as opposed to change the positive. I don't care. Just get to 230 and understand that you're adding back depreciation. Now, gross cash flow minus gross investment equals free cash flow. That's straight out of the book. That's the definition of free cash flow. So what is gross investment? Sure ones. It is, I'm going to give you the shortcut first. It's change in invested capital. So off the TFI. My invested capital went from 380 to 440. So it went up by 60 plus current year's depreciation. And then free cash flow is gross cash flow minus gross investment. So this company generated $150 million of free cash flow, operating free cash flow last year. Now, in case you're curious where this data came from, give you a couple quick formulas here. So the first formula that matters is I want to get to gross investment. So what is gross investment? Well, first of all, it's going to be change in working capital. So what is change in working capital? It's current working capital minus last year minus previous this is a terrible keyword, previous working capital. Have to bring this back to the Apple Store. All right. God, it's crazy. All right. That's changing working capital. And then I need CapEx, capital expenditures. Well, what is CapEx? Well, if I take my starting PP&E and I add my CapEx and I subtract my depreciation, I get my ending PP&E. Just kind of the mechanics of the accounting world. Start with my PP&E, add whatever I buy new, subtract my depreciation, and that'll be my net PP&E balance at the end of the year. So I'm going to reorganize. End. Not the dend, it's the end. So what is CapEx? CapEx says take my ending PP&E minus my starting PP&E and then basically add the depreciation because I moved to the other side. So when I do my change in invested capital or my gross investment, when I add working capital and CapEx together, it's basically my change in invested capital, and that's where the plus depreciation comes from. Just mechanically. We'll have more time to go through this in a later class if you have questions about it, but that's the shortcut. If you wanted to mechanically do it, you'd get to the same answer. Right? For interest of time, I'm just going to do it very quickly. So let me go back to CFI. That was the 80. Yes? Well, it goes back to what I just did here. It's because of this. Because when I take the change in working capital plus the CapEx to get my gross investment, CapEx is basically the end PP&E, the start PP&E. Working capital is current and previous working capital. That's the change in the invested capital, but I have to have that plus depreciation as part of the CapEx. That's what carries through when I actually do the math. That's what's happening, just mechanically. So it's a shortcut. We can do it manually, but I'm trying to save you a little bit of time in the interest of this video. So back to this. That's my free cash flow. Then I repeat the process for the non-operating cash flow. From the income statement, any non-operating cash flows, well, that was the after-tax equity income of $3 million. Then from the balance sheet's always about the change. So this is change in non-operating capital. So my non-operating equity investments went from 15 to 25. So they went up by 10. Those are my twos. So I basically need my non-operating cash flow. All right, here's again, I don't have a hard and fast rule. You'll struggle with this on your homework assignment. You have to think through the signs. There's no always. So you generate $3 million of after-tax equity income. Does that add to your cash flow or take away? That should add to my cash flow, right? Make $3 million of profit, I have more cash flow. I spend $10 million buying another business. Does that add to my cash flow or take away? It's going to take away. So you have two choices. You're going to get to -7. You can either take 3 minus the 10, or you can flip this sign and say that this is a negative cash flow, and then add these two together. But in either case, this company spent $7 million on non-operating activities. It got 3 from the income statement, and it invested 10 more into the balance sheet. So therefore, it netted -7. So when I do my CFI, it's the 150 from operating activities, the -7 from non-operating activities, 143. Now, on the second side of the statement, I need to get this to balance. So I need this to be 143. Again, distributions are positive numbers. So let's start with the debt. The first debt number is the income statement, TII. It was the after-tax interest expense. I gave 15 million of the 143 to the bondholders. And because it was a payout, it's a positive number. I don't have to change the sign. My change in debt, my debt went from 225 to 200. So my debt went down by definitely got to get my keyboard fixed. My debt went from minus that. It went down by 25. If I retired 25 worth of debt, should this be a positive or negative number? Distributions are positive, so therefore it's a positive number. If I'm paying it off, if I'm paying off my debt, it's just like paying interest to them. It's a positive number on this side of the statement. That's Modigliani-Miller. It's not GAAP. 3. Dividends, not net income. I then paid a dividend of $103 million. Again, just like distributing the interest expense, I'm distributing that dividend. It's a positive number. And finally, my change in equity. My retained earnings went from 170 to 265. It went up by 95. Positive or negative? I'm basically borrowing more income because it didn't go to the shareholders. That should be a negative. By the way, this is how you will do the assignment if you don't know what's going on. You'll just keep changing numbers, positive and negative, until you try and get everything to balance. I'm not saying it's the way that you should do it. That's not a good way, but some of you will try to do that. And so again, you just sum all these up, and you know you need to get to 143. So 143, and the answer is nope. So obviously it can't be negative 95. So let's switch this to positive 95. Uh-oh. My statement doesn't balance. And switching it from positive 95 to negative 95 doesn't get it to balance, so there must be some other error going on. This will be your frustration. I will tell you, you can change all the numbers in the world, and the statement will never balance because this is tricky error number 2. So I already gave you a hint for tricky error number 1, which is dividends, not net income. If you tried to put net income on this statement, you would never get it to balance because net income is not the cash flow to shareholders. Dividends is. So that's tricky number 1. Here's trick number 2. Where does this change in equity coming from? Where's the change in equity coming from on this balance sheet? Retained earnings. Is retained earnings a cash account? No. If you have a change in a non-cash account, does it affect cash flow? No. That's trick number 2. Change in retained earnings never affects the cash flow statement. If you try and put it on there, it'll never balance because you put a non-cash account onto a cash flow statement. So, on every balance sheet, retained earnings is never part of your cash flow statement. It's never part of the CFI. So, dividends, not net income. But on TII, net income, not dividends, because dividends is not part of TII. But when you get to CFI, you got to flop. And signs. Generally, on the top of the statement, inflows are positive, outflows are negative. On the bottom of the statement, the funds flow, financing flow, outflows are positive, inflows are negative because the two sides have to balance. This is what I mean by footing. So, clean view of the company. They generated $150 million of free cash flow. They spent $7 million on non-operating cash flow. They had $143 to distribute. Of the $143 to distribute, $15 went to interest, $25 to paying off the debt, and $103 went to shareholders in the form of a dividend. Clean Modigliani-Miller lines of cash. Statement number 4, economic profit, EP for short. 2 ways to get economic profit. Again, need my years. All right, so 1, I take my NOPLAT, equal my NOPLAT, take my NOPLAT off the TII, and less the capital charge, and that will get me the economic profit, also known as EP for short, also known as economic value added, but since Stern Stewart trademarked that, we can't call it EVA. That's EVA. All right, so long story short, how do we get to capital charge and economic profit? Well, believe it or not, we now have a clean ROIC because we also know invested capital. Invested capital. Actually, I'll just copy and paste since I can't type. TFI, operating invested capital right here. For the last 2 years. All right. So I am going to ask you for what's called a BOY economic profit, and BOY stands for beginning of year. It's not boy, it's actually beginning of year. So to get a boy economic profit, we will calculate a boy beginning of year ROIC. What is the beginning of year ROIC? It is the current year NOPLAT divided by previous year invested capital. So the end of year invested capital is the beginning of year invested capital. So basically current year NOPLAT divided by last year's invested capital. 55%. I could have asked you for an end of year invested capital, in which case you'd have taken the 210 divided by 440. I could have asked you for an average invested capital, which is 210 divided by the average of those two numbers. Those 3 are common. I will be specific about what I'm looking for. Right now, on this assignment, I'll be looking for beginning of year. Current year divided by previous year ROIC. I will give you a whack. Let's say it's 10%. Make it up to 10%. So that you will get a spread. Spread equals ROIC minus WACC. So, what is capital charge? Capital charge is the 10% cost of capital times the operating invested capital. I have 380 of capital at the beginning of the year. I need to make 10% on that. 10% of 380 is 38. My economic profit is the 210 that I made minus the 38 of financing cost. I did 172 better than what I needed to break even on financing. Said another way, I have a 45% spread. My economic profit is my 45% spread times the operating invested capital, 172. 172 equals 172. This is the matching and footing statement of economic profit. So, economic profit, again, it's in the book. It basically says how much value did we generate above NPV 0. And if you have a 0 spread, you have no economic profit. 10%. So, in this case, we don't have a 0 spread. We have a 45% spread. So we have 172 economic profit. Because on 380, 10% of 380, we had to make 38. We actually made 210. We did 172 better than 38, which is what the 55% represents. Just rearrange math. But those are your 4 statements for your next homework assignment. Yes?
What was EP? The spread times what?
Which one? Economic profit?
Yeah.
The second way of calculating economic profit is spread times invested capital. The first way of calculating invested profit is no plat minus capital charge. Capital charge basically being, I'll write it here, IC times WACC. And spread is ROIC less the WACC. And technically, this is a boy ROIC where BOY means beginning of year. All right, other questions? Okay. So